So good morning, welcome everyone to today's Climate Week panel discussion in partnership with Sustainalytics, Financing a Greener Future. I am Alexi, Head of Sustainable Finance at CCP's CEO Investor Forum, and I will be the moderator for today's panel. Before we get started, I really wanted to just thank the Climate Group for their continuous support and effort in bringing governments, corporates, investors, and organizations like ours together to convene and discuss pressing climate initiatives and issues as well. I have to say I'm particularly optimistic about today's solutions-based conversation because we get to discuss how companies are leveraging debt capital markets, not only in transitioning to a low carbon economy, but also financing innovative products and services that are geared towards addressing today's most pressing challenges. With me today are esteemed panelists from Sustainalytics, Morgan Stanley, and JP Morgan. Our star lineup includes Head of Sustainable Finance at Sustainalytics, Heather Lang, whose team collaborates with leading global underwriters, lending institutions, and issuers to allocate capital towards sustainability performance through innovative financing instruments. We would also like to welcome Jamie Martin, Executive Director of Morgan Stanley's Global Sustainable Finance team and my former colleague, who is responsible for delivering sustainable investing products and solutions across the firm's institutional securities, investment management, and wealth management divisions, and drives the adoption of sustainable investing strategies seeking to achieve competitive financial returns alongside measurable positive environmental and/or social impact. He is also, notably, a former representative on the executive committee of the Green Bond Principles and B-Lab's Multinational and Public Markets Advisory Council. I just want to say quickly, congratulations, Jamie, to you and the team on Morgan Stanley's net zero financed emissions commitment that came out just the other day. We're looking forward to hearing your perspective from the investor side for today's session. And then lastly, but certainly not least, joining us from JP Morgan from an issuer perspective is Catherine Hunter, Vice President of Sustainable Finance for Corporate Responsibility. Catherine leads the firm's corporate responsibility client engagement efforts by advising public and private corporate and large family offices, their clients on corporate responsibility and ESG topics. So we're thrilled to have you here today with us. You will be hearing directly from Catherine as it relates to JP Morgan's recent $1 billion inaugural green bond issuance. Congratulations on this exemplary milestone. Can't wait to dive into that deeper. Today's dialogue will explore everything from corporate issuer and investor viewpoints around what is driving increased green bond issuances, barriers to scale, its role in corporate long-term climate strategy, and much, much more. We'll try to do our best to entertain a Q&A at the end of the segment. However, if we don't have time, we'll, given everything we have to cover, feel free to ask your questions and we'll definitely note them and ensure that we address them at another time. So while we have a lot to cover and a lot of insights to share, before we dive in, I wanted to just take a brief moment to conduct a quick poll to gauge whether our audience's companies have shifted focus from climate change to COVID-19. So if we could pull that poll up, panelists, feel free to engage as well. It would be great to hear your perspectives on this. The question is, how has your company's commitment to addressing climate change shifted to address COVID-19? Feel free to just select your answer. We'll give it a few moments for those to come through. Excellent. Can we pull up the results? Okay, great. So we have the majority of participants saying that it's remained steady. So addressing climate change has, more or less not really changed since the emergence of COVID-19. And we'll get into that a little bit further during today's panel. Before turning it over to the panel, I thought it would be good to take a step back and level set. More than ever, companies are shifting their long-term priorities to address the impacts of climate change and now, of course, COVID-19 and the racial inequities within our social and economic infrastructure we see more than ever. as a key driver being the rise of stakeholder capitalism, as institutional investors are making it clear that they are looking for companies that drive sustainable value for all stakeholders. So this no longer just means investors, but includes consumers, employees, suppliers, and of course, communities. As a result, investors are increasingly pivoting towards companies that effectively communicate their plans to meet these broader stakeholder expectations, and that can anticipate and mitigate these prevalent climate and other related material ESG risks across their lines of business, while using corporate purpose, something we take very seriously at Chief Executives for Corporate Purpose, as a North Star. At CEO Investor Forum, we believe that to really drive impact, CEOs and investors must jointly commit to changing how success is measured in the capital markets and move from a focus on short-term metrics to an emphasis on long-term value creation. Our proprietary long-term plan framework empowers CEOs and corporate leaders to proactively set the context, own their narrative in the market, and ultimately lead for the future. A key macro theme, and why I bring this framework up, is capital allocation. This enables CEOs to detail strategies, including their plans to address anticipated physical and transition risks stemming from climate change, and also raise capital to fund a greener, more sustainable future. In the capital markets arena, these plans are coming to life. The first half of 2020 saw over $200 billion in sustainable bond issuances globally, with green bonds accounting for nearly half of that. So with that, I'd like to turn it over to the panel and kick it off with Jamie to kind of set the context here. One trend that we've been seeing in response to COVID-19 has been an increase in the issuance of sustainable bonds. So that's the combination of green and social bonds. From your perspective, it would be great to hear how you would size the market today and where you think it's headed.
Great, thanks Alexa. Can you hear me okay?
All set.
Great, well, hi everyone. Hope everyone is staying equally safe and sane. I think, as Alexa alluded to, from our seat in the Global Sustainable Finance Group at Morgan Stanley, there is even more focus on sustainability issues, how they're, communicated, how they're financed, and ultimately how they're driving to positive outcomes. And whether it's COVID-19 or social justice or certainly financing the transition to a less carbon-intensive economy. These are systems-wide challenges that investors, corporates, policymakers, regulators, individuals, all need to start, rowing in the right direction cohesively to get to where we need to go. So I think there was a school of thought that ESG sustainability might take a back seat once the bull market dynamics disappeared. But again, we're seeing even more focus on these topics and some real, I think, creativity as the market expands as well. So I think, Alexa alluded to green bonds and social bonds and sustainability bonds, which are all, continuing to gain traction. I think what we're seeing really is a expansion and acceleration of what had been kind of the green bond format across three areas, and I can break this down. The first would be an expansion of the use of proceeds, so what these financial instruments are being used to finance. The second would be an expansion of the asset classes that they're going into, so beyond just investment grade bonds. And the third would be the expansion of issuers, new issuers that are coming into the market as well. So this is a busy slide that you can use as a backdrop to my comments. I won't go into all of the details, but we're on pace for continuing the kind of hockey stick growth that we've seen across the green bond, social bond, sustainability bond market. It's still a very small portion of the overall global fixed income issuance each year, but it continues to grow. I think, again, across those three areas of expansion, if we start with the use of proceeds, sustainability bonds, as Alex mentioned, can basically combine both green and social. And I think, we're excited about companies like Alphabet, who issued a sustainability bond to the tune of $5.75 billion over the summer, going in energy and efficiency and using use of proceeds to finance to racial equity, commitments around affordable housing in the Bay Area, and frankly, getting quite a bit of credit in the market for taking that really expanded view in their sustainability bond. In terms of new asset classes, I mentioned, traditionally, green bonds started with, being issued by the World Bank and IFC and the Asian Development Bank, et cetera. We're seeing, that expand into certainly the investment grade universe, with companies like Verizon coming to market again recently, and being, repeat issuers, Verizon, Starbucks, both good examples of that. But then we're also seeing new issuers come in who, in the high yield market, Hannon Armstrong, a company whose entire business model is around helping buildings and real estate become more energy efficient, have now issued, multiple green high yield bonds. We did a transaction late spring for a company called Plug Power, which was the first U.S. company to issue a green convertible bond. Again, their company is very focused on using hydrogen as a transition fuel. So I think, the green bond and format is becoming the expanded tool in the toolkit, regardless of how companies are interacting with the capital markets, and investors have been very supportive about that. All the deals, in this kind of green and sustainability format are oversubscribed. There's a lot of demand. There's frankly a supply-demand mismatch, since so many of the asset managers have built, sustainability funds, ESG funds, and they need product to fill those funds. I think, the third area after, expanding use of proceeds and into new fixed income asset classes will be new issuers coming to market. We mentioned Alphabet. They don't tap the debt capital markets very frequently, and when they do, they come in size. They obviously spent a lot of time synchronizing their sustainability strategy with their financing strategy, and I think that's what investors really respond very well to. They want to know exactly how the green bond is linked up with the corporate strategy, and if there's a disconnect there, companies can get penalized. I think in terms of other issuers, just quickly on the social side, we've seen CDFIs, community development financial institutions, raise significant amounts of capital through the traditional capital markets. And this summer, Morgan Stanley was involved with a few very large national foundations, specifically Ford Foundation, MacArthur Foundation, and Doris Duke Foundation, who took advantage of where rates are right now to borrow anywhere from $100 million to $1 billion in the case of Ford Foundation, to really accelerate the grant making that they're able to do in light of COVID. So really stepping up and being kind of backed by their significant endowments to unleash capital to the organizations that need it most right now over the next 12 to 18 months. And then, kind of combining all that, I guess the other development is within building, new incentives into the structure. So some might be familiar with SDG-linked bonds or sustainability-linked bonds. The first of these was done by the Italian utility company last year called Enel, where they issued an SDG bond and basically said, we have an internal goal to shift from 45% of a renewable energy mix to 55% by 2022. If for some reason we do not meet that goal, the bondholders will receive a 25 basis point step up in the bond. So, our company's cost of capital would be increased if we don't meet our sustainability goals, which I think is an interesting way to synchronize and really signal to the market how much commitment a company has. And then we saw a Brazilian paper company, obviously deforestation is a huge issue in Brazil, This company is called Suzano. It came to the market a few weeks ago with a sustainability linked bond, and they had a similar structure where if they don't meet certain emission reduction targets over a certain time frame, again, a 25 basis point penalty, essentially step up, would be triggered to the bondholder. So we haven't seen that transaction come yet to the U.S. It's happened in Italy. It's now happened in Brazil. Others are watching it closely, and I think again, as investors signal the importance of these issues, if a company can really create that synchronization in the bond structure, it's going to continue to be well received. So again, in summary, I think this is going to continue to accelerate. Companies are being, I think, pushed from a variety of different directions on this topic. And I think, at Morgan Stanley, we're thinking about it, how to really help our clients navigate the ESG landscape in light of COVID, and also, what, as Morgan Stanley, how we can, disclose and improve on our own sustainability journey as well, which I can talk about some of those commitments as well.
Absolutely. Thanks. Those were great insights. A lot to unpack there. We can spend a whole session, I think, discussing more about the market. And I just wanted to note, with the recent market volatility due to COVID and climate change and other challenges in the economy at this time, it's great to see that at least the issuances, there's still a lot of traction, investor traction there, and the proceeds have places to go, and there's definitely relief efforts that need that fundraising. It's also great to see, as you mentioned, foundations entering the space more and more. I'd love to see more corporate foundations. We have a few foundations on the line today, and I know that they're intrigued by looking at capital markets as a new resource for raising funds for their grant making, as you mentioned. So that's a great insight there. I wanted to shift over to Heather. Recognized as the world's largest second-party opinion provider for green and sustainable issuances, it would be great to also hear your perspective on behalf of Sustainalytics, how sustainability bond issuances have changed and where you see the market headed in the next 3 to 5 years.
Sure. Thanks, Alexa. And just to pick up on many of the threads that Jamie already touched on, obviously we've seen a tremendous amount of growth in the market, and underpinning that growth, we've seen a lot of diversification in types of issuers and the industries that are represented here. We still see many of the large financial institutions driving the market in many ways, both as underwriters and issuers. But we've also seen an increase in non-financial corporates entering the space, and including new industries like over the past year, tech, telecom, shipping, big pharma, luxury apparel, beverage manufacturers. So really spanning the gamut across different industries. And that's something that I think we can expect to see more of moving forward, especially as the market opens up to heavier industries through accessing transition financing. So that's one interesting thread. Innovation and use of proceeds is another important development. Of course, we're seeing, we've historically seen that 3 specific green bond categories have been the most popular, those being renewables, green buildings, and green transportation. But we have seen a lot of expansion into new use of proceed categories, innovative categories like circularity, socioeconomic advancement and empowerment, water management, gender, to name a few examples. And we've seen also a lot of issuers moving towards multiple use of proceed categories in lieu of a large single asset, as we saw more in the past. And then, Jamie touched on sustainability linked bonds. Yeah. Obviously, that's an expansion beyond use of proceed categories into more general purpose financing. And so that's another key development, a very recent one in the field. And I think it really picks up on the success of sustainability linked loans, which was the fastest growing market segment for the past 2 years. And we saw the International Capital Markets Association release the sustainability linked bond principles quite recently, and have certainly noted a great deal of interest from issuers in this, because I think it provides a lot more flexibility through these general purpose loans. In addition to the two sustainability-linked bonds that Jamie mentioned, there was a third that was issued last week. We worked on it, on a second-party opinion for it, and actually JP Morgan was the underwriter. The issuer was Novartis, and it was a $2.2 billion sustainability-linked bond issuance, and the sustainability performance targets were focused on access to strategic therapies in low to mid-income countries. So we're quite excited about that.
On your work with that. Yeah, that's huge.
Thank you.
Great.
In terms of the next 3 to 5 years, I mean, it's hard to know what's going to happen in the next 3 to 5 months in this dynamic market, but maybe a couple of speculations. Transition financing for heavier industries to accelerate their decarbonization efforts. I'm certain will play a key role in the expansion of the market, and we'll touch on this a little bit more in a few moments. I think also we can expect a greater emphasis on climate adaptation measures to mitigate future global crises. So things like stormwater management, flood protection, forest fire prevention. We haven't seen a lot of climate adaptation bonds to date, so I hope we'll see more of those in the coming years. And then maybe just in a broader context, I expect that we'll see more mainstreaming of sustainability and ESG factors as inputs to assessments across all types of entities and transactions, not just sustainable bonds, sort of along the lines of how this is played out with ESG integration in the equities space. I'm happy to pick up on that thread a bit later as well.
Yeah, that's great. Thank you. That was very interesting. How would you say COVID has played a role in the increased demand that you've seen over the past couple of months or in the last quarter on the sustainability bond issuances, but also perhaps the sustainability linked loans on that end as well?
Sure, yeah, and so I think it's made a surprising and volatile market even more so. But I think, you know, after a brief dip in green bond issuance back in the spring when the pandemic set out, I think we've seen it rebound really quickly, both on the green bond side as well as the social and sustainability bonds. In fact, there's definitely been an uptick in social bond issuance since then, and so I think that's been a really exciting development in the market. We've also seen some new use of proceeds become defined, particularly in two main areas, one being healthcare, which could include like R&D around vaccines, subsidizations of related pharmaceuticals, access to healthcare, and then also on the socioeconomic impact mitigation. So looking at the economic impact on small to mid-sized enterprises, on disadvantaged or vulnerable groups that have required extra support during COVID. Yeah.
That's great. That's interesting. I was also wondering if we could take a step back and provide some additional context for listeners. Can you walk us through, again, going back to Novartis, your recent bond issuance with them and the support you lent there? Could you walk us through the issuance flow from Sustainalytics' position, particularly in the pre-issuance phase, just to get a full bird's eye view of how you supported Novartis with that?
Sure. So the green bond issuance process is quite similar to that of a plain vanilla bond, and some of the key differentiators are that obviously, well, in the case of a use of proceed bond, you would have to identify the pool of assets to be financed across one or more use of proceed categories. And then you'd have to develop a specific framework that outlines the process for selecting, managing, and reporting on those use of proceeds in accordance with the International Capital Markets Association's green bond or social bond principles. And I think we've seen that underwriters are playing a very key role in working with their clients and supporting them through that process. Where Sustainalytics or another external reviewer would come into play is we would receive a draft of that framework, and we would use that as the basis for developing a second party opinion. And we would cycle back and forth with the client a couple times on the second party opinion, on the framework to a lesser extent, prior to the issuance. And once it's finalized, then the issuer can share that second party opinion with with potential investors, either on a roadshow, also posting it online. We have an inventory of all the second party opinions we've worked on our website as well. And then there's an expectation also that an issuer will publish annual reporting regarding allocation and impact of proceeds after the issuance to share with their investor clients.
That's very helpful, especially a main question we get from a lot of corporates and foundations is how do we break down the ecosystem of the issuance flow? There's a lot of key players that are plugged in at different points in time throughout the issuance. And, we get a lot of questions around what is the difference between a second party opinion provider and the actual ESG rating? And how do those two kind of come together and facilitate investor confidence in the bond? So to that respect, what role do ESG ratings play with respect to investment in sustainability bonds or green or social?
Sure. So despite the emphasis on use of proceeds, I think what we're seeing in the market and hearing from underwriters that we work with and our investor clients is that investors are really interested in understanding the sustainability commitment and performance of the issuer, and also their ability to manage related risks. And so this is something that we've always captured in our second party opinions. But we also know that many fixed income investors are looking at our ESG ratings when they're considering investing in a bond. And interestingly, that's happening not just when it's a green or sustainable bond, they're doing it when they're looking at a conventional vanilla bond as well. So what we're starting to see is that ESG ratings are really starting to play an increasing role in an issuer's capital raising activity. And this is most prominently demonstrated in sustainability-linked loans, where you'd actually see interest rates being directly linked to improvement of an ESG rating, such as Sustainalytics. But I think more broadly, we've seen that developments where leading credit rating agencies are starting to consider ESG factors in their assessment of credit worthiness. And I think this speaks to that mainstreaming trend that I referenced a little bit earlier.
Absolutely. The ESG criteria is definitely getting more integrated across Moody's and S&P, and just seeing how it evolves into those final ESG ratings or the corporate rating, and then how it kind of translates into the diligence that the second party opinion provider does as well. There's definitely a lot of, not to use this word again, but diligence that goes on in the pre-issuance phase.
Yes.
So, we just walked through the flow. It'd be great to turn it over to Catherine Hunter from JP Morgan. We're thrilled to have you represented today as kind of our case study for what we've just talked about, which is great. And congratulations, first and foremost, on the firm's $1 billion inaugural green bond issuance due in 2024, right?
Yep.
Great. It would be great to hear a little bit more about your process now that, again, we had that additional context on how Sustainalytics plugs in, and also Jamie from the investor perspective. And, not only the process, but the goals of the issuance itself, and ultimately how you see this and future issuances tying into JP Morgan's long-term climate strategy. We mentioned increasingly that investors are looking to have the proceeds tracked over the tenure of the bond. So it'd be great to just kind of hear from the one that you issued, how you're set up for that.
Yeah, of course. Thank you. And we're so excited. We've had a long history as an underwriter in the space, but to actually have issued now has been very exciting. And I think Jamie had made a great point earlier just around that synchronization of an issuance with a larger sustainability strategy. And so
Absolutely.
In that same vein, we're very much, this is one part of our larger firm-wide sustainability strategy and our efforts towards a lower carbon economy and clean transition as well. And I think just, to the process standpoint, we worked with Sustainalytics to receive our second party opinion. They were able to review to our sustainable bond framework that we established. And this issuance focused really on just 2 eligible green project criteria. The first being green buildings, and so we're focusing on LEED Gold and Platinum buildings, and then secondly, renewable energy, so onshore solar, onshore wind, solar, small scale hydropower, and geothermal as well. And so, you know, as we think about that kind of transition as well, we think that we can really focus on those areas. I would step back and say, again, just because of that extremely important tie around the sustainability strategy, that you may recall back in February, the firm made an announcement at Investor Day, basically expanding our commitment, not only to help address climate change, but also to promote further sustainable development. And so I'd say, while our green bond obviously is focused on the former, that, you know, particularly in this environment as well with COVID, that those, you know, larger furthering of UN sustainable development goals on both the social and economic development categories are extremely important too. And so as part of that expanded commitment, you know, we've set a couple of goals, you know, one being to facilitate 200 billion in financing in 2020. And so again, those will be to projects and lending that supports climate change, and also, again, advancing the UN sustainability goals. Also, you know, a goal to commit to resourcing 100% of JP Morgan's global power through renewable energy. And so that will start in this year. And also, you know, an interesting point too is just around market-based solutions that, you know, when we think about how to address carbon emissions, we've worked with the Climate Leadership Council and also the Business Roundtable to focus on that. And I'd be remiss to say that when we think about kind of this transition too, that the firm has enhanced its restrictions on financing both for coal mining and also coal power, and also prohibited financing for new oil and gas development in the Arctic. And so all of those initiatives together, along with our inaugural green bond issuance, are very much part of that strategy.
You're covering a lot of ground, and that's exciting, especially on the climate front. We need it. I just wanted to pick your brain a little bit about internally for that green bond issuances. Can you shed a little bit of light? We have a lot of different audience practitioners on the line today: corporate social responsibility, sustainability, maybe some investor relations as well. And it'd be helpful to know when you go to market with a green bond, how do you kind of organize internally? What teams do you tap to ensure that they're aligned with your impact objectives more broadly, with your purpose, and, you know, ultimately maybe even mapping back to the SDGs that you just mentioned? So that'd be helpful.
Yeah, of course, it's a fantastic question. And it really is a huge working group that we formed internally, because to your point, there's so many constituents that are involved in this process. Obviously, corporate treasury is involved, because whether it's a vanilla or a green bond, our corporate treasury team needs to be involved. The sustainability team was involved, obviously, and that ties back to setting the firm's strategy and also our commitments. And so to make sure that our projects and our efforts are in line with that larger commitment, the sustainability team was involved. Obviously, legal review and environmental and social risk management are huge parts of this process too, to make sure that all of our tracking around eligible projects, et cetera, and that it's tracked and reported correctly as well. And lastly, you know, obviously our media relations and IR and comms teams have been an important part too. And so it's really a full group effort on that front.
Family affair, all hands on deck. And to that note, how much time, I'm just curious, giving you some questions off script here, but how much time would you say that internal organization takes to get everyone together to break down some of those silos, and, you know, eventually go to market with a cohesive message behind the proceeds of your bond, to attract investors, et cetera? Just for folks on the line who are curious to know, you know, again, what the time period is. And a follow-up question to that would be, how long in advance do you plan for some of these bond issuances? Again, the green bond, let's focus on that one. Understanding that the maturity is long-term, it has a long-term outlook. How would you kind of counsel other corporate practitioners that are looking to organize themselves around how much time it would take to organize internally, and then how to really think long-term about the impact of that bond issuance?
Yeah, of course. No, it's interesting. This, you know, in addition to bringing a lot of people together, I think when you bring a lot of people together, and it also has to be so strategically aligned, that there can be a bit of lead time that's needed for that and stuff. And so I would say, you know, even as far as a year in advance, and we think it started backwards planning from that commitment first. And so again, what does the firm want to do? What's our commitment? What are the tools we can get there with, one of which is a green bond? And then to gather those people and to make sure, for example, as we created the sustainable bond framework, to make sure that was in line with the strategy, that the processes, for example, for tracking and allocation exist, and that, for example, the correct assets can get hashtagged in a correct way, to think through the reporting structure of that as well. And so, anywhere from 6 months to a year, I'd say would probably be keeping in mind that larger strategic goal. And to your point on the forward-lookingness too, and that's often the sustainable bond framework enables firms to think about this not just in the context of one issuance, but programmatically. And so in that context too, it's very much that the ability to not only issue green bonds, but social bonds and sustainability bonds, and over a longer period of time, just tie into that as well.
That's great. Thank you.
Yeah, I would build on that as well. I mean, that's been our observation, working with, corporates that, traditionally the sustainability function has been, siloed. They're responsible for putting out the sustainability report. And now you're seeing companies really elevating, whether or not they have a chief sustainability officer, they're rolling that, sustainability perspective out in front of investors on non-deal roadshows. They're, I think, much more, again, I think, amplifying that strategy, and the green bond format can be another way to do it. I mean, sometimes CFOs or treasurers are, hesitant around the green bond format because, there's not, I think, concrete evidence that it's going to lower their cost of capital necessarily, although we're, starting to see things go in that direction. But that whole kind of cohesive, cross-pollination that Catherine was describing is a very valuable exercise for the company to go through, especially with, helping IR really message this in a way that investors can take action on. So I'm sure the green bond is kind of maybe the end product, but again, I think that entire kind of sequence and steps, it takes time, it does take effort, it does take resources, it does take the expertise of a Sustainalytics to really kind of get that top echelon attention and framework and certification. But yeah, we think it's only in the company's best interest to really embark on that as well.
Absolutely. And thinking about, pivoting over to the post-issuance phase, what you just said just reminded me of the different teams that may be involved with the tracking of the proceeds afterward. Sustainability teams, for example, how are they working to kind of really ensure that they're effectively communicating and reporting out on the proceeds of the bond issuance over time to meet investor expectations?
Yeah, I can talk from our end if it's helpful, but just, and Heather had mentioned, the annual reporting, and that's something that, obviously we're committed to that transparency and regular communication. And so in our issuance specifically, we'll be putting out an annual report publicly until all of our proceeds are allocated in full. And along with that, just from a best practice standpoint, thinking through, our firm's also going to provide a management attestation for that, in addition to having a related report by either an independent auditor or a third-party ESG consultant. And so, can't underscore enough the importance of both that regular and transparent communication and reporting.
That's great. Jamie, how is Morgan Stanley seeing corporations reporting out similar to what Catherine Hunter just mentioned?
Yeah, I mean, I think that's a key element that investors want to see, right? They want to make sure that the money that they're lending to the company is actually being used for the projects and initiatives that the company, identifies in their green bond framework. And so, I think there's also the tracking of this both internally at Morgan Stanley, but externally by the market as well. And I think it's, that, quantifiable outcomes that ultimately, we want the green bond market to be connected to. Sure, again, there is a marketing aspect to this. There's a halo effect. Everybody in the ESG market sees when a company comes with a green bond, whether or not they're fixed income investors or not. I think there, again, are the commitment that the company is making by, locking this in essentially with the green bond is very important. And I think the tracking and the internal processes to make sure that the right information is being disseminated to the market is absolutely key, and it's going to have to happen over the life of the bond as well. And yeah, we're seeing more, again, kind of the expansion of this. Another transaction just to highlight is the one that we did, Stanley with PepsiCo, which was very focused on circular economy and helping them basically source capital to reimagine, the use of plastic in their supply chain. I think those types of developments, and now, yeah, we're engaged on how to. They've committed to quantifying it, and now they're due now almost a year since that to come out with their first progress report, essentially, to the sustainability bondholders of that, which is going to show quite a bit of progress. So I think that's only going to continue.
Yeah, I think that's great. At a macro level, it kind of speaks to how critical locking in metrics, standard metrics, ideally, for corporates and foundations alike to report on going forward, just to maintain that investor confidence, and also just to ensure that you're communicating your long-term strategy, not just in the post-issuance phase, but as you achieve that tenor and that maturity as well. Wanted to kind of shift gears and go back to the poll we took initially at the start of the segment. One concern that has been raised in the wake of COVID is the increase in social focused bond issuances. I know we touched upon a little bit of examples there during the session, but wanted to kind of highlight the movement away from the focus on green bonds. This is just a general question for either of you, but do you see this focus on COVID bonds as a negative for environmental change? Is it restricting progress we could have on the climate change front that we should be driving towards?
I'm happy to start off there, and then maybe others can jump in. I mean, I think it's overall a very positive development that we've seen. I think that the ability of this market to pivot quickly, and issuers being able to basically move capital on very short notice to some of these types of use of proceed categories that really respond to the pandemic and other timely social issues, I think bodes well for its ability to address future crises, including environmental ones. So you could imagine that again, in the case of an environmental shock or crises, you can already get signals of how the market is going to respond. And I think that some of the social use of proceeds are also really addressing, supporting, building resilience, demonstrating how we can help build the resilience of either nonprofit organizations or targeted groups that are really bearing some of the brunt of the economic hardships posed by COVID. And I think, again, all of this, I think, bodes well for how we would adapt to potential environmental issues. And also through sustainability bonds, we're starting to see more interconnections between the social and environmental issues. And I think we're seeing a lot of discussion in the market about those interconnections. And so sustainability bonds will, I think, continue to gain traction in addressing both simultaneously.
Thank you. Just wanted to also stay with you, Heather, for a separate question with a number of representatives, again, from corporate foundations that we have on the line today. It'd be great to hear your take on the recent rise in sustainable bond issuances coming out of the foundations to fund their grant making and to kind of emphasize and build that muscle for when their endowments are committed to other initiatives and other impact objectives, how they can be raising capital in the capital markets, which is an innovative new approach that seems to be gaining a lot of traction. So where do you see this use of creative financing headed in the philanthropic space, and how else would you recommend philanthropies tap into sustainable finance solutions to really maximize that social or environmental impact? Some examples that would be great that I know you've supported in the past are the conservation funds, green bond, and you also have Ford Foundation really paving the way and setting the example that hopefully corporate foundations can model as well.
Yeah, thank you. We're really excited about the uptick in social bonds that have been issued by foundations. Green bonds to a lesser extent, but I think most of the recent issuances, including some of the ones that Jamie referenced earlier, Doris Duke, MacArthur, Mellon, the two you just mentioned. Yes, we've had the opportunity to work with all of those issuers and providing them second-party opinions, and it's a natural fit, obviously, for their mandate. With most of the use of proceeds have focused on socioeconomic advancement and empowerment. That's been a key theme, particularly in light of the context of COVID and the socioeconomic context there, as well as with the renewed emphasis on racial inequity has been another area of focus. And yeah, I think so. With the low interest rates and the opportunity for these foundations to draw additional granting from a bond on top of what they're already getting from the endowment was really sort of a natural opportunity for them, and it enables them to really mobilize a large amount of funding at a time when perhaps other sources of funding for charities, for nonprofits might be lower than usual, but arguably higher demand than ever before. It's probably limited to some of these large. I mean, not all foundations can leverage a public bond in the way that some of these foundations have been able to. But I think now that we've seen this leadership from a handful of large US-based foundations, they've all been based in the US actually, there's an opportunity for others to follow suit in other regions, as you noted, corporate foundations as well. And to look beyond bonds to other potential sustainability instruments, of which there's no shortage of developments in this space to look to for inspiration there.
Great. Yeah, as you said, I have confidence that it'll naturally and organically be a right new track for corporate foundations and foundations. So I'm really looking forward to seeing how that evolves over the next year or 5 years as well.
Yeah.
Wanted to open it up to questions from the audience. We got a great one here. What are the main challenges issuers face when going to market with new sustainable products? I think, some that come to mind on my end are definitely a few that we discussed, the barriers to scale around the lack of standard metrics and tracking those proceeds. Also resources internally that you have to dedicate to tracking that over the tenure of the bond. I think another one is definitely some confusion around what the premium pricing may be of a sustainability or green social bond. So, opening to everyone, and I just wanted to also make sure, Catherine from JP Morgan standpoint, would be great to also hear any issues you may, or challenges, let's call them, that you encountered when issuing that inaugural $1 billion green bond. So Jamie, you want to kick us off with that question, main challenges?
Yeah, I mean, I think there's, can be a bit of an education gap in terms of what qualifies for a green bond. And I think, use of proceeds are fungible. There is, what's known as a look back period. So you don't necessarily need to have, $1.5 billion of projects ready to go, that instant. I think it's about supporting the strategy overall. And then, yeah, I mean, I think the size, for, large publicly traded companies to be benchmark eligible, I think it's like a $300 million minimum size. So sometimes there's some confusion around that. And then I would say just the other challenge we touched on.
Could you mention that?
Really, yeah.
Sorry to cut you off. Could you mention that size one more time? I didn't hear that.
Sure. $300 million is usually what's needed to be, what's called benchmark eligible, which I think, most companies, if they're going to go through the exercise, they want to be in the benchmark. So, but yeah, I mean, we've seen, a range of different sizes. And then again, I think it is, very important to make sure that the C-suite is also communicating and, fluent in why the company is doing this, right? So investors want to hear from the CFO, they want to hear from the treasurer and the sustainability function. And if there's a disconnect there, ESG investors really key in on that and start asking potentially difficult questions. So I would, yeah, again, it's kind of that synchronization that Catherine and I were talking about earlier.
Excellent. Catherine, before heading over to you for that real-time example, wanted to just kind of pick up on something you mentioned, Jamie, and I think we didn't mention it in the session, but greenwashing. I think that is also a challenge to kind of clarifying what is the criteria by which you can label a bond green or social or sustainability. Heather, I know you'll have some thoughts there as well. So Jamie, if you just want to kick us off.
Yeah, I mean, I think, Heather mentioned the ICMA, the green bond principles. I think greenwashing is something that I believe is becoming less prevalent, just because investors are going to penalize companies that come to the market with something that doesn't pass muster on this. And that is, frankly, reputational risk that I would think any company would want to avoid. And I think, but it's the process really that, Sustainalytics and the banks have an advisory capacity to, hopefully avoid that situation. And I think it's our reputation as well, collectively, as as a global financial services company. I think there's more co-opetition in this market with our peers. And it's in our best interest to get this all going in the right way, and that it's not just a marketing exercise, that it leads to accelerating the transition that we know needs to happen.
Yeah, maybe just to build on that. I mean, I think there's so much scrutiny in the market that that really, I mean, I don't think that issuers can get away with it in the way that they once did, and especially if they're working together with leading underwriters like JP Morgan, like Morgan Stanley, like others in this space who have really developed dedicated expertise in sustainable finance, and also working with a second party opinion provider that can mitigate it to a certain extent. And also, I think it's worth noting, the taxonomies that are being developed are particularly the EU taxonomy on use of proceeds and green bonds. I think is really providing a lot more detail around what would be expected in different use of proceed categories, whereas the green bond principles, I think, define those a lot more broadly. And on one hand, that's great because it provides lots of scope for innovation. I think that some of these more elaborate and detailed taxonomies are really being clear on what types of thresholds issuers should be looking at with respect to different use of proceeds. We've developed our own taxonomy here at Sustainalytics, a very detailed living document that is informed by all the new issuances, and that allows us to also make sure that we're very clear on what the strengths of these approaches are, but also about identifying any potential limitations.
That's interesting. Is that taxonomy applicable to corporates outside of the US as well, in Europe and potentially in Asia?
Oh yeah, it's a global taxonomy.
That's great, because we've received a few questions, naturally so, that around how the EU's green bond issuance framework may impact the market there, and how it makes you think about how the US is kind of leveraging some of the frameworks and standards coming out of the EU to really inform, although it's not enforced by regulation here, how to go about in creating frameworks that really direct and help corporates navigate successful issuance. I wanted to turn it over, make sure Catherine gets a chance to discuss, any challenges you particularly saw when you issued the inaugural green bond.
Yeah, that's great. I think, Jamie had actually said just the coordination with the C-suite as well. And I think that that's a really important thing that is coming from the top down, that it's not just a sustainability effort. And so I think that coordination over time too, and again, systematic and kind of programmatic efforts are really important. I think probably the largest, and I say challenge just in that anybody issuing faces this, is to that point around the tracking of just making sure that, especially for a large financial firm where there's many lines of business in different ways with which we participate in both green and social efforts, of actually making sure that not only are all those hashtagged, but various kinds of assets can be committed to our sustainability commitment, to the green bond, to other issues as well. And so just having that really robust tracking system along with the risk management around that and the team, I think is something something that, the importance of it is there. And just, to have the manpower to do that is definitely something top of mind.
Excellent, that's helpful to know. Heather, there's a question directed at you here that I think would be helpful to expand on. You mentioned climate adaptability and expectation that this is an area for further development. How do you think this will happen? This audience member was thinking in particular bloom bonds, water bonds, support the blue economy and coastal communities. What does private capital need to see for that to grow? So again, further development for climate adaptability.
Yeah, I think a lot of the emphasis that we've seen in green bond issuance to date have been more focused on climate change mitigation, and I think obviously that's very relevant and important. But as we start to see more of these major environmental crises like the forest fires that are taking place on the West Coast and flooding, that really just looking at different innovative technologies and solutions that can be developed to really help us to adapt to those new realities. And so I think in part it will just be prompted by global events and how things continue to play out, and that need for ongoing ability to innovate and to adapt. Maybe one more comment that I wanted to add, because we didn't get to talk about transition bonds at all, and so I think that is really going to be a very important area of growth as well in the green bond market, and because I think there really is that recognition that achieving international climate goals will require significant reduction in GHG emissions from the most carbon intensive industries and activities that we think of as transition sectors. And to date, we haven't really had heavier industries involved or getting access to green finance, because they really haven't had the low carbon solutions at the level that could be scaled. And so I think moving forward, that is really going to be another key area of development in ensuring that business activities are aligned with transitional pathways that are compatible with long-term climate goals. And yeah, that'll differ obviously from one sector to another. Just defining what those transitional pathways will be will look very different, for example, for natural gas than it will for steel or for shipping or for other sectors.
Absolutely. When we look at ESG materiality, I think a lot of the proceeds coming out of these sustainability or green bond issuances will be able to ideally link back to what is material to your sector, what do you want to focus on. And again, in transitioning over to that low carbon economy, that's going to take financing. We've seen with COVID that a lot of companies, of course, had their relief efforts, they had a relief budget, in their back pocket, that ran out pretty quickly. So a great resource that we saw was, and I think that really speaks to perhaps the increase in social bonds over the last quarter and before summer even, is really their acknowledgement of using the capital market space to raise capital as a approach to risk mitigation, which you touched on quite nicely. So thank you for that. We are 1 minute out. I wanted to just thank my panelists today. Thank you so much for all these insights. I'm excited to share the recording, so participants who weren't able to make it can definitely share this with their team. It would be great, we're always seeking to improve our webinars. If you could take this NPS score, which will let us know basically how we did and inform how we can improve going forward. So 1 to 10, think of it as, would you recommend this webinar to someone? That'd be really helpful. And with that, so go ahead, take a few minutes to fill that out. And thank you again to you, Heather, Jamie, and Catherine. This has been extremely, extremely insightful.
Thank you very much, everyone.
Rest of your climate.